Partners of the Financial Executives Consulting Group. Thank you for joining us today when we go over trends impacting your working capital. We're going to start the main body of the presentation in just a moment, but a couple of administrative announcements. You are in mute-only mode, which means that you can hear me, but unfortunately I can't hear you. If you do have questions about today's presentation, please type them into the question box on the lower right-hand side of your screen, and we'll get to them at the end of the presentation. If we don't get your question, or if there's questions you don't want to ask on an open mic basis, not to worry. Myself, Bob, or Roger will be able to get to you offline. So with that, let's start the presentation. And Bob, why don't you start today's webinar?
Okay, thank you, Bruce. Well, welcome everybody from the FANG organization, and we have UCLA Extension invitees. Welcome to the webinar. We have a very interesting and provocative session this morning, I think you'll find. And we hope that this is the beginning of a long and creative relationship between FANG and UCLA Extension, and that this is the first of many such webinars. You know, one of my responsibilities as the chairman of the FANG Credit and Working Capital Management Group is to help members and others attending today to stay aware of economic trends that are going to basically impact every business. So that's the intention today. Roger Tornanen, as you can see from his bio, is an expert in this field, and he's put together information today from the most recent data to help you with strategizing your working capital management going forward. The economic conditions we face are challenging, to say the least, and what Roger is about to discuss impact areas such as how you manage your accounts receivables and how it's going to be impacted by the trends that he's going to be describing, your accounts payable management, interest rates, your revenues, and then another thing that isn't often talked about, but it's your supply chain viability. The things he's going to be talking about will impact all of these areas. And then we're going to give you some thought starters and how you can try to manage through this and looking at each component of your cash-to-cash cycle and set some strategy to deal with the information that Roger's about to present. So, like Bruce said, we've allowed time at the end of the presentation for questions. We certainly welcome those. You can put those in the chat, and Bruce will inform us of the questions at the end of the session. So, with that said, Roger.
Bob, thank you very much. Can you hear me all right?
I can.
Great. Bruce, thank you, and I appreciate the opportunity to address a number of the members of the Financial Executives Networking Group. I'd like to start out and mention to you that the entire presentation will be archived, so you can refer to it either on the FANG website or UCLA Extension's credit website. Some of the slides are a little bit busy. The presentation can be a little bit intense, so sit back, relax, think about it, and keep in mind that all the material will be available should you want to go over it. Our objective today is really with a target audience in mind of an advanced discussion of key long-term trends that are directly impacting our cash equivalent balances, inventory building, or reduction, accounts and notes receivable and payable, as well as business continuity in total. We do recognize the determinants of the 2007-2009 meltdown, and if that surprised you, then this webinar will arm you for a future black swan event. That's my hope. And a black swan event for us is a major credit industry disruption. The overall economic environment and your industry's health may negate your well-intentioned credit practices and policies if you miss the bigger picture. So we're going to talk about the bigger picture and the impact of that. Let's jump in. First of all, the Federal Reserve is super important for all people in credit really to understand. And I'm going to go over a little bit of background because a lot of people, even in credit, don't seem to understand the Fed itself. The Fed is owned and controlled by the largest banks in the United States, also with a few members of European banks in control positions. Bank of England being one of those. It is not a government entity, and the Federal Reserve is a total monopoly that can create unlimited amounts of dollars, and it's accountable only to Congress. It has not been audited in over 50 years, and it fights attempts to audit it. In the past 6 to 7 years, the Federal Reserve has created almost $4 trillion while keeping interest rates close to zero. And it is now the key buyer, has been for a few years, and the financial source for U.S. Treasury debt. It is the key buyer supporting our U.S. budget deficits. The Fed earns over $100 billion a year because it owns so much of the interest-bearing debt. Again, has only Congress oversight and no audits. The annual expenses of the Fed are close to $5 billion, so that leaves a lot of money left over. Given at the end of the year, the Federal Reserve residual money is turned over to the U.S. Treasury. During the year, there is no close accountability, and I would say no accountability for how the money is spent in managing markets. Essentially, the Fed directs efforts to rebuild a crushed banking system that occurred about 7 or 8 years ago, and it's an enabler of U.S. deficit borrowing. So the problem is the Fed can't change course or unwind, and there are few, if any, buyers for their vast asset portfolio. Their bet is that the U.S. and world growth and bank profits will allow an unwind someday, somehow. And we can see the impact on this overhead that the Federal Reserve for many decades had a predictable balance sheet. In 2007, traditional Treasury holdings, you can see in the blue. And then we went into the financial crisis that just about took down the international financial system. You can see how mortgage-backed securities became a primary asset of the Federal Reserve, and that has grown since 2013 when this forecast was made. This was an amazingly accurate forecast that was made 2 years ago. We are on track to approximate $5 trillion on the Federal Reserve balance sheet, pretty much as forecast, and the bulk of the amount of money in the Fed that they've created has been spent to support federal agency debt, mortgage-backed securities in the turquoise, and also in the long-term Treasury purchases. And you can see in that little triangle how that has ramped up. And we'll talk about the reasons why that has ramped up and why that's important for you to understand. The foreign buyers of U.S. government debt are finite. If you look at the pie chart, who owns the U.S. debt, you'll see that the China, Japan, and the darker brown and beige, along with other foreign nations, own 8% plus 7% plus 19%, right? So they own about a little over a third. The Social Security funds themselves own 16%. The Federal Reserve is rapidly growing in their ownership from 12%. And what might be really important for you to keep in mind, in the past year, China and Japan combined have not increased their purchases. While the U.S. debt has continued to skyrocket, China and Japan owned, coincidentally, $2.5 trillion in January of this year, and they owned $2.5 trillion a year earlier. So they've had no increase in their holdings of our debt. Other countries have had nominal increases, and that pretty much takes out foreign purchasers who are traditional buyers of our debt. They're standing aside. That's danger. All other owners of U.S. debt, the Social Security is now in runoff, as you read in the newspapers. The Social Security funds are being depleted. They're not new buyers of debt. State and local governments are not new buyers of debt. They themselves are in deficit spending. U.S. households are stressed and are not major buyers in any event. And the retirement funds that are buyers are also stressed, underfunded. So the bottom line, the takeaway is the Federal Reserve is the buyer, the controller of the U.S. debt. And that has historical implications, which we could talk about later. And we see another chart which shows, and this chart is actually from the Federal Reserve, from St. Louis, the St. Louis Fed, that shows the ramp up in the purchase of U.S. government debt up until pretty much the present day, how dramatically that's gone up versus history. Meanwhile, the average or median household income of American families, by taking inflation out, is lower than it has been in almost 20 years. There's been a gradual decline in U.S. real spending in the families across the country, is down approximately 8%, and some of these numbers you can question, and we're actually going to talk about the background of where some of the numbers came from. But this is a key part of the environment for credit. U.S. employment. The news announcements are that employment is up month to month. In reality, the U.S. employment has been on a plateau since about 2000. And if you look at the curve that goes all the way back into the 1940 period, the U.S. economic growth has really resulted in a real steady growth in jobs. And if you continue the curve on up, and you can use whatever rate you want, you can see that, and the Anderson School at UCLA actually determined that we are 15 million jobs under where we should be. So as the administration indicates that they're creating jobs, keep in mind that we are 15 million jobs under where we need to be and where we've been historically, to basically allow people to come out of college, come out of high school, get jobs, and have income to build their families. We'll talk about that more in a minute. Another view of the dramatic change that we have in the employment market is a major downward change in the number of people who are counted as employed versus our population. You can see on this chart how we have dropped from over 64% of all of our population being civilian employed to 58%. Another indication, and you can see the small amount of an uptick that's coming from that. This chart actually has another meaning which I would put as a bookmark that you should consider for the future, is that civilian employment itself is a defined term in the government, in the Bureau of Labor Statistics. If someone has been out of work for a long period of time, they're not counted as the employment base. So that has a way of making the numbers we're going to look at in future slides look a little bit too high. A final indicator of the stress that we have in our consumer environment, which directly affects commercial, which directly affects consumer and commercial credit, is that we are at least 5 million jobs, full-time jobs, behind where we were back in 2008. The Bureau of Labor Statistics and the various bureaus report that the employment is going up, but what's happening is largely the amount of increases in employment are in part-time jobs. In Los Angeles, in particular, we have fewer full-time jobs in the Los Angeles County marketplace than we had 25 years ago. So as you look at the job reports and increasing employment, think full-time jobs, and full-time jobs are a serious issue and are holding us back. So we have employment, but down. We have a gap between where we should be to have full employment. That's 15 million jobs, and of the jobs we report, we're behind 5 million full-time jobs. So this is compounding issue. If we go to charts that a lot of the audience here would recognize, if we look at businesses, the survival rates are pretty much consistent over 5-year periods starting back in 1995. And a lot of you on this conference call know this. You're in the credit business. You full well know that businesses that have been in place about 5 years have survival rates of about 50%. So the businesses that are here today, 50% will fail. And the way that we have made up that in our economy in the past is we've had more and more new businesses, right? So we've been making up for that. And in fact, the Bureau of Labor Statistics counts on that. They actually count on a lot of new businesses. The problem is we don't have the new businesses. And what we have here from the U.S. Census Bureau itself is show a chart in the blue triangles that shows the number of employers. They peaked at about 2007 at about 5.6, 5.7 million numbers of companies that were employers and have been on a downtrend. So for the past 7 or 8 years, we have not been creating the new businesses. And the part that has been on an uptrend has been the non-employers. These are individual companies, sole proprietorships, that were on a pretty healthy course until about 2006 or so. And even the individual businesses, the sole proprietorships, are on a plateau. So there's an issue in the company creation as well as the job creation. Going back to the consumer environment, in total, which makes up a large part of our gross domestic product of the United States, when we take the realistic percentages of inflation out of the gross domestic product, and let me just back up and explain something briefly. The gross national product of the United States is the sum of all of the goods and services produced during the year. It's the market price. And to get the real gross national product or gross domestic product, inflation has to be taken out of that sum total of goods and services that are calculated. So if you assume a large inflation rate, you take that out, you have very low growth or you have no growth. If you assume a very low inflation rate, a lot of the measured market value is assumed to be real value. A company called Shadow Government Statistics, which I would invite you to Google and check their website, has been in the marketplace for a number of decades, and they specialize in keeping government statistical reporting consistent. And there are a number of inconsistencies that take place. Adjustments are made. They focus on consistency. And their estimate is that our inflation rates that affect the gross national product are at least 2 percentage points higher than those reported officially. And if you want more background on that and you want to see how that's calculated, I invite you to go to their website. They have been in the industry a long time, supporting pension funds, investment banking firms, banks, and so forth. But their conclusions are, which is borne out by a lot of the other statistics, is that the U.S. has not been in much more than a bottom bouncing mode since the end of the financial crisis, if it's at an end, but in 2009 or so. This has a great deal of implications for credit for vendors and for the quality of accounts receivable. Companies historically have counted on growth, basically growth in the marketplace, to, in worst case, bail them out, but the growth in the marketplace, once price increases are taken out, we don't really have measurable growth in the marketplace. And when we look at the total United States, for real domestic growth, we haven't really had any since about 2007. And all that has been done here is that the government reported gross domestic product is deflated or disinflated by a slightly larger percent that arguably more reflects a truer indication of the inflation rate. And even if this is argued that a little bit too much inflation is taken out, it's kind of scary that a small adjustment in inflation redefines whether or not the United States has had a recovery or has been in a long-term recession. That alone is a little bit on the scary side. If we look at retail sales across the country, deflating on the same basis, we can see why maybe a lot of retailers have had cost increases, expense increases that have eclipsed their sales increases. So the real growth, that's the real sales per square foot across the retail industry, has not been changing positively. Someone's coughing. When we look at the unemployment rate, the unemployment rate has its own issues, and the unemployment rate has been defined and redefined many times. During the Clinton administration, approximately 5 million people who were in the unemployment lines were redefined to be out, and that was in the mid-1990s. And as we go forward, we go through adjustments in unemployment, but the main themes that I really want you to take away, the red line is the official unemployment that is reported by the government agencies, and that is called the U3 index, and that shows a decline of the unemployment rate down to closer to 5%. The very same agency definitions report the U6, which is the gray line. So nothing has been done to change this data. It's been taken strictly from U.S. government sources. And the U6 line reflects those people who have not been looking for a job after a month. And I don't want to make you all experts necessarily in unemployment reporting, but every month 50 to 60 families are polled, and the basis of a lot of this information comes from those surveys, and the family base of 50 to 60,000 is refreshed gradually over a period of 6 months or so. So the base itself is a good base. But the questions asked in the survey are along the lines of, have you looked for a job in the past 30 days? And if you say no to that, you're in the U6 line. If you answer the question, have you worked in the past 30 days, you're employed. So there's not a discrimination made between part-time and full-time. When we recast the numbers through the shadow government statistics company, we show that the chronic unemployment, the people who have given up looking for jobs, the people who have been unemployed for actually more than 6 months, more than a year, adding back people who were defined out of the labor force, we have an unemployment rate that stubbornly rests in the 22 to 23% area. Some of the numbers could be debated, but the trends are really not that debatable. And the recovery, if we have a recovery, it is certainly leaving a lot of people behind and leaving behind a lot of purchasing power. And we see that pretty much through everything we look at. And I promised we'd come back to inflation, and we are. The agencies who monitor inflation use hedonic pricing, and any of you who want to know more about this can Google HEDONIC, hedonics, and consumer price index, and you'll see that every month as consumer prices are announced, it's after an adjustment has been made. If it's determined that the quality of an automobile has increased by $200, then a $200 amount of the price of a car is subtracted before the consumer price index is calculated. So the market basket itself of goods and services is constantly being massaged. by people making assumptions about quality changes. If these assumptions are taken out, we have inflation rates that run closer to 7% than 1 to 2%. And there might be a question about why that would be advantageous to report lower inflation than a constant market basket of goods and services would require. One reason is that low official inflation subtracts less from the gross national product adjustment. So it can make us look as though we have growth, or it can show higher growth numbers in the economy, and that generally for politicians is preferred. A low official inflation also adds smaller adjustments to Social Security payments. So those who are retired who feel squeezed, maybe they should feel squeezed. And that's important to keep the Social Security Medicare expenditures running as long as they can, which everyone has pretty much agreed the levels are not sustainable, that the amount of the Social Security funds will run out totally in 10 to 20 years, depending on your assumptions, 30 years maximum, best assumptions. So we are in runoff where we are using what is called a Social Security Medicare Trust Fund, which is really not a trust fund, but that's a separate issue. The money that has gone into Social Security has been used to buy government securities. So now that the Social Security monies are in a runoff mode, government securities actually need to be sold rather than look at Social Security as a buyer. And a low inflation rate that's reported makes us feel more comfortable that all is under control and we shouldn't worry. So there are a lot of reasons why inflation rates that are low inflation rates have advantageous reasons for reporting, but I suggest look at your expenditures, look at your experience. If you feel inflation is in the 1 to 2% range and you calculate that based on your expenditures, wonderful. Very few people can say that. The issue that we are facing, it's basically the debt. And this is a perspective I have not seen elsewhere, so I will present it for, since we are a credit audience. If we look at the debt, the U.S. debt per family, we have about $750,000 of debt per family right now. And this amount does include the present value of Social Security related deficits, and present value is a key word. We all know that the government reports on a cash basis. If they sign a contract for a joint strike fighter, they'll record the $10 billion they paid this year as a payment, but they may not record the $200 billion commitment they made in the future. So they'll report the cash expenditures. So on a cash basis, the U.S. government is running a deficit of perhaps $500 billion. But on a generally accepted accounting principle basis, which you all know about, if the government were forced to live on that basis, they would be reporting a $5 to $6 trillion annual deficit. And the same goes for the Social Security payments. As the payments are made, they're part of the cash deficit. But this amount that is in front of you recognizes the present value of the excess payments expected above and beyond the collections. We also know that each family in America has approximately a $200,000 mortgage and education debt, credit card debt. We compare that against a family savings amount on the average of less than $8,000. A bit disturbing. Even the $200,000 for mortgage and education and credit cards, that would be a bit disturbing. Income per family, this is a little bit different income number. This is not a deflated number. We have 1.8 earners per family. We have income per family of about $52,000. So how does that feel to have a $750,000 plus $200,000, almost $1 million debt load with income per family of $51,000, $52,000 a year? I'll let you answer that. Before moving on, I would also say the government, our government does have a generally accepted accounting principles audit. It's not given a highlight in the news media, and it's certainly not highlighted in any speeches that I've seen. But if you do Google U.S. government, GAAP, Generally Accepted Accounting Principles, audit or deficit, you can ultimately come upon an annual audit that's done that does show the $5, $6, $7 trillion per year that I mentioned, but it shows one more item. It shows that the accounting firm doing the audit does not do a clean sign-off, that they point out that they are not getting the quality of data that they need to actually complete the audit, which again is maybe not a surprise to some of you. But moving along, the Federal Reserve, as we mentioned, has increased their balance sheet from $800 billion a year to $4.5 trillion in 5 years. And they're pretty much the buyer of all Treasury bonds, Treasury notes, and Treasury bills. They have been over the past few years. Banks use these Treasuries for repos. The repos are used for derivatives. And the banking system themselves creates approximately $1 quadrillion of face value or notional value derivatives, which the Bank for International Settlements in Switzerland has estimated carries with it $20 trillion of derivative exposure that could be net to the world banking system. And as you might suspect, this is more than the capital of the world banking system. So as the derivatives are created, we do have a source in the world that is actually looking at the market value, the notional value, the sales value. And here is another issue if you don't have enough issues to think about, but we're not going to go into this. Overall, small businesses are not forming as they have in the past, and much less they're not hiring. There are a number of bank and finance roadblocks, as you know. A lot of the money that's being available for the banks is being put back into the Treasury market and deposited with the Federal Reserve, buying our U.S. debt. The larger businesses continue to convert from full-time employees to part-time as they can. Obamacare, I would say, was not the cause of this, but it certainly has not helped this. The largest businesses have healthy financials, but no aggressive expansion. And so what you read about lack of aggressive expansion is pretty much confirmed all through our data. Finally, in terms of looking at the debt and looking at the leverage of families, looking at the leverage of the United States, before we assume that we're going to grow our way out of this, think about the unemployment rate and use a lot of caution before assuming that we have a recovery, much less the growth to grow out of the problem. Are we having a return to a healthy credit marketplace? Since the consumers are 70% of the U.S. economy, and we already have looked at the average U.S. earnings adjusted for hot inflation, including fringe benefits, are no higher than they were 40 years ago. This is an analysis made by Lawrence Kotlikoff of Boston University. So I would refer you to look at his research. He also looked at what it would take to get on the track of not only not incurring more U.S. debt. In other words, we owe about $200 trillion of present value U.S. debt versus the $18 trillion that we report that we have, because that's based on cash expenditures and the government obligations that are used to raise the cash to pay for the cash expenditures. The ability to pay debt, $200 trillion in Lawrence Kotlikoff's analysis, recognizing that the federal government debt has gone up fourfold in the past 10 years, and it's worse than all developed countries and climbing. He pointed out $8 to $10 trillion per year in GAAP terms. We would need to have a permanent hike in all federal taxes by 57%. We would, along with that, we would have to have an immediate and permanent cut of all non-interest federal spending by 37%. So for us to get into a mode as a country when we're even deciding that we're going to be making repayments of this large amount of debt over a period of 30 years or so, this is the magnitude of change that we would have to make today. So it's a big issue. moving toward the next credit financial crisis, if you don't feel that we're moving closer and closer to another credit and financial crisis, I apologize, because we absolutely are moving closer to a next credit and financial crisis. I'm not able to talk about the month of the year, and back in 2006 we were not able to talk about the month of the year of a housing crisis, but we knew when U.S. families had no savings and they couldn't afford to pay their mortgages across the U.S., we knew we were headed for a mortgage crisis. We know we are headed toward another credit and financial crisis. It may be a quarter away, it may be a year away, it may be a year or two away. I would find it amazing to believe that it's 3 or 4 or 5 years away. But what are we looking at now in terms of the dollar, which is a key to maintain? We're looking at China, Russia, India, and OPEC moving away from holding dollars. We would point out for your consideration that Chinese yuan transactions now occur in 220 countries, and it is expected that 50% of all China trade in 5 years will be accounted for in the Chinese currency. We now, in terms of their trade, which is one of the largest trade volumes in the world, certainly for the United States, for imports, their trade exceeds euro-dollar settlements. They are getting into bond issuance, including McDonald's, including the United Kingdom, including British Columbia, where $90 billion or so far has been sold in yuan bonds. There are yuan currency swaps in place in 23 countries. This is all wildly different than it was a few years ago. This is very current. Last year, China signed a deal with the European Central Bank for $500 billion in currency swaps. The Shanghai Cooperation Commission is an institution that you'll begin to hear about. It is an association that's been in place for some time, for over 15 years, but it's becoming more active in my view. It's a commission that includes Russia, China, obviously China, but Russia, India, OPEC, some of the OPEC countries, not all of them. And the European Economic Community is a participant. They're not a full member. But the Shanghai Cooperation Commission has been a stimulus for Russia and China settling their trade in oil, as Russia now is the largest purchaser of crude oil that's exported. China is the largest purchaser. Russia is on par with Saudi Arabia in their exports, on par with the United States in terms of our production. So Russia and China have agreed to settle their petroleum imports in terms of yuan and ruble as opposed to the dollar. India is wanting to be a member of this group. They've been an observer for a number of years. Several OPEC countries are members and observers, so that I would keep an eye on the Shanghai Cooperation Commission. My bet is that none of you have heard of it, but I may be wrong. China-Russia trade pretty much is focused on avoiding U.S. dollars, and this joint trade has gone up 9 times in the past year. That's worth thinking about. The Southeastern Asian trade deals are pretty much, with China involved, are all in yuan now. And if we move back to the U.S. briefly, touch back on the U.S., we are still having our budget fights. We are still having polarization in the parties. We're still printing money for the Federal Reserve to buy our debt because China and Russia and others are not buying our debt. We still have deadlocks. We still wonder what the implications of Obamacare are. We see more companies going to part-time. We see those of us who look at the real picture in terms of real, I'm talking about taking inflation out. We see economic stagnation. We also see inflation in the United States higher than reported. And we're comparing ourselves versus the common market, and we're comparing ourselves even in some cases versus Greece. The dollar's been very strong in the past couple of years, and the Greece situation and the European common market uncertainty has certainly been a good stimulus for that, but Greece will be resolved. I don't know what the resolution will be, but it will be resolved. Either Greece will be out of the common market or it will be subsidized. And once that resolution takes place, it's my expectation that the euro is going to be a very different relationship to the dollar. But again, this is an educational discussion. I'm not your financial advisor. Bottom line is, over the next year or so, maybe the next quarter for sure, we'll see increased volatility. I would not be surprised to see the euro go up or down 1 or 2, maybe 3% in a week or two. So this is kind of an expectation. If I were a credit director or a treasurer, or if I were in the position of having payables or receivables for exports or imports, I want to think about this. We are looking at, in the United States, a more extreme dual economy. We're getting used to chronic underemployment. There will be a time when we officially recognize it. This is going to be a little bit more along the lines of some of the European countries, the position they've been in for years. We don't see the stimulus, and we don't see the long-term growth we're growing out of this, unfortunately. So if, in terms of capital shocks, and again, if we want to remember what a capital shock was, we can go back only 7 or 8 years. We are preferring not to count on a return to across-the-board growth. We are not counting on full employment, and we're not even counting on low unemployment. We are counting on a sleepy world that will wake up at some point, but so far continues to accept dollar-denominated trade. And we also are counting on, and pardon the arrows that must have slipped up in the translation, but we are counting on a world-controlling Federal Reserve that not only is lending to our banks, but lending to European banks, not only buying our government debt, but reportedly buying some Eurodollar debt. So the problem is I can only use my best sources since the Federal Reserve won't be audited, refuses to be audited. But so far the Federal Reserve has kept interest rates at historical lows, and that arrow should really be also pushing toward keeping U.S. deficits financed, and another arrow that has been pushing toward keeping our own country in a low volatility mode. We're getting used to stocks creeping up. We're getting used to commodities stable, in a stable mode. We're getting used to bond prices reflecting 0% interest rate or a very low interest rate. We prefer to start planning for credit and working capital strategies ahead of the next crisis. Currency risks and the impact of U.S. company trade extension are a part of our plans. Interest rate risks and the impact on money availability, and importantly the cost of funds. The realities of continuing and a more severe recession. There is some discussion now about inflation really being in place. There's some discussion about a more severe recession. Maybe we didn't come out of a recession. Now is the time to focus on reevaluating your cash-to-cash processes. More closely manage the components of your cash-to-cash cycle. Monitor your accounts receivable more closely, particularly international. Step up the financial status review of critical customers and suppliers to stay ahead of payment or supply disruptions. Don't be shocked at a replay of 2007, 2009. Think about adding process automation efficiencies in your credit and collections operation. Open or reopen discussions with leaders in the credit process automation area. Make sure you more closely manage disputes. Anticipate companies managing their cash so tightly they're going to use disputes as payment delay strategies. Gee, imagine that. Well, imagine it in the international environment. Other companies that are not located in the U.S. making you the victim. Manage your accounts payable to increase cash, or others will do it to you, and they will anyway. Be sure you have adequate borrowing capacity to iron out the rough spots and manage interest exposure. Lock in today's interest rates whenever possible and increase cash balance cushions. I know most treasurers and most CFOs want to minimize. They want to keep cash balances pretty low. They want them deployed. If they need to be deployed, I'd make sure I can get my hands on them very quickly. My final part of a presentation is looking at the past 20 years or so. And we had a tech bubble. We remember that, many of us. We had a crash. We had a housing bubble. We had a crash. We're having a bond bubble. And based upon everything you've seen before this slide, don't be surprised if we don't have a sudden reversal in the bond market. So the newer credit watch, as I see it, have more obligations, accounts receivable and notes receivable in U.S. dollars. I would not be holding foreign currency accounts receivable or notes receivable. I would get fixed versus variable rate financing as much as possible now. Be careful of higher interest rates and how they might affect some of your customers or your vendors. Leverage companies are going to be impacted. Pension funds have been impacted. Private and corporate investors have been impacted and will be impacted, but it depends upon the industry, and the banking industry will again be impacted. And I think about that quadrillion-dollar amount of notional derivatives the banks have essentially been responsible for. It's only about 10 banks, by the way. It's not every bank. Look carefully where your liquid investments are parked, and your illiquid. I would be holding more T-bills than prior. Even though the dollar may get beaten up, I'll know what my dollar payment terms and schedule is, which is almost immediate. Become more interest rate on the more sensitive, interest rate sensitive businesses, more expert on them, like housing. And I'm listing a group of others that I'm going to leave on this overhead and hope that you would come back and take a peek at it. But the main theme, I think, of this chart is that we've gone a long way with a lot of assumptions, and we've gotten used to them since 2009 for sure, and the underlying economics really tell us, and they yell at us to rethink these assumptions. And there are some on this conference call who wish they would have done that in 2005, 2006, 2007, if they would have only known. Well, I suggest that maybe you do know now. UCLA Extension offers a credit certificate program, and we offer it online around the world. We invite you to take a look at it. It's a 6-course program. We have key practitioners who focus on the consumer, commercial, and the global credit market. We focus on how to analyze credit and how to write and present credit analyses and business law. And we have an elective for a specific job interest area like portfolio management. So many employers reimburse these courses. They are focused on professional development for sure. Invite you to take a look. The link is here. Or you can Google UCLA Extension courses and take a look. Thank you very much. This is a normal end of a presentation attribution and disclosure. I'm a member of UCLA Extension. I'm a director. I have a lot of networks that go into the Anderson School and to UCLA and other schools. I'm representing my viewpoints. I'm not representing theirs necessarily. I'm a certified financial planner. This is not a financial planning discussion. This discussion is in the educational domain. I hope it has triggered some new thoughts for you. It won't be a waste of your time. I do thank Dr. John Williams, who's the editor of Shadow Government Statistics. I thank the Anderson School for some of their data, Bureau of Labor Statistics, the Census Department, even the Federal Reserve and other sources. I thank them for the work that they've done. And above all, thank you for the credit management audience that FANG has put together and the support that the credit industry has given UCLA. I appreciate it. And now I think we're good for questions.
All right, thank you, Roger. And Bob, thank you. So at this point, if you have any questions, please type them into your question box, and we will take them in turn. Roger, do you have a last slide here, I think, with your name and contact information on it?
Sure.
Okay, we've got a little bit of time for some questions. Here's a question. As a VP of credit, your assessment concerns me. What steps should I take to be sure my staff can deal with potential customer creditworthiness or cash flow issues?
I think I would really go back and reevaluate policies that have been in place for a while in the company, and I would really ask the staff to go back, look at how much of the business is international business, how much of the receivables are international receivables, notes receivable, accounts receivable. I would look at the major clients who are a part of the business and maybe make sure that I'm on top of a fresh credit report, or at least I have the information that I could get in terms of an update on credit worthiness. And I would also ask them to look at alternatives and talking to the Treasury Department or speaking to consulting resources about activities that I could undertake that would lower my dollar exposure should we have, or when we have, a change in the dollar that's in an adverse direction. I think all these would be very valuable, and you'll have a lot of benefit.
Okay, thank you. Here's another question. We manufacture machine tools for domestic and export use, and we export approximately 40% of our revenues to European and Asian customers. We find that they're buying less because of the valuation of the dollar. Based on what you have presented today, what do you think the mid to long-term prospects are for our activity to get back on track?
I think it will get back on track. I wouldn't pull my hair out and give up on that. I think it will get back on track, and again, it goes directly to some of the topics that were presented, and it takes a very small amount of concern in the credit markets to generate a response to a recognition of inflation or a recognition of further pullbacks by buyers in the Treasury security markets. We've seen both of these consistently evolving over the past 3 or 4 years, if not longer. So I would probably roll with it a bit longer and do all my other best business practices, and obviously look for large additional markets and do everything that you're doing. But I would be getting ready for the cycle change.
Okay, here's a question. Interest rates have been historically low. What happens when they return to normal historical rates with regard to the U.S. debt?
That's going to be a very serious issue, and it's almost another presentation by itself, and that is we directly borrow about $18 trillion right now, and a 2% increase, 2 percentage point increase in our interest payments result in almost $400 billion of additional deficit, which doubles the official government deficit, approximately, that's being reported. And a track back up in interest rates has serious implications that the Federal Reserve, as long as they can do it, in my view, they will continue to be the buyers of last resort of the debt, and they will undoubtedly try to buy the additional debt. But I'm more concerned about what the uptick in inflation, or which would be inflation also, but the uptick in interest rates would do toward due diligence, that people say, well, now let's take another look and let's see what really seems to be going on. And there would be a possible fear that an uptick in interest rates will generate into a very large uptick, which I don't necessarily predict, but a scare of any kind in the balance that we now have generated, where everything has to work perfectly 24 hours a day around the world. Everything has to work perfectly to keep a scare from occurring and to keep the stability in place. My worry is that's a place where a black swan event can happen, where we can't keep it so well balanced, and the reaction will be in the bond market. And our debt will not only be more difficult to finance, it will be at higher rates all across the curve for everybody, where the the value of bonds themselves will drop considerably. And it's in the 30-year bond environment, if interest rates go up 2% or so, you can expect 30-year bonds could drop as much as 30 to 40%, which is huge. That creates another round of issues in our pension funds, underfunding. It creates another round of issues in companies. It creates rounds of issues everywhere. So it's the unexpected impact of an interest rate that in the long term concerns me. In the short run, I think we count on the Federal Reserve to continue to buy securities, but that may not be sustainable in the world marketplace.
Okay, thank you. Here's another question. I'm the CFO of a mid-sized manufacturing business. We have business in the U.S. and Canada. We went through a tough time during the recession, and so we've kept our administrative staff and cost structures pretty lean. We're now seeing some pickup in business. In light of the risks you have identified, what actions do you suggest I take over the next 12 months with regard to my AR and AP staff?
Well, the U.S. and Canada is very interesting, and I've not looked specifically at the Canadian market in the depth I have in the U.S. or some of the other markets, but the Canadian dollar and also the Australian dollar, for that matter, they have actually gotten weak as the commodities have gotten weaker. I think we all see that, but if we have the inflation ripple going through, which we will have, that could have a very positive effect on the Canadian dollar and the Australian dollar. So I would be looking at my exposures, and I'd be looking at my businesses with a higher Canadian dollar in mind.
Okay. Here's a question. For my company, we happen to have a lot of cash on hand. We've been very lucky. How do I know how much liquidity is enough? What should I do with some of this excess liquidity if I can determine what it is?
Well, I think following what occurred with the banks at a very high level is not a bad idea. We went into, as a country, we went into stress testing, and the banks have added a lot of capital since 2009 based upon stress tests. So essentially, to take an Excel spreadsheet or have one of your financial analysts or a consultant take an Excel spreadsheet and look at the key categories of assets and liabilities on the balance sheet, look at your operations, and just do some modeling. It doesn't have to be detailed modeling where you model the whole company, but it can be by major accounts on the income statement and balance sheet, and basically do some what-ifs. And that would be my recommendation. A lot of what-ifs by a financial analyst in this environment could be done in a day. It doesn't have to be complicated. And I think at that point, you'll see the imbalances or you'll see the uncomfortable ratios given some various scenarios on interest rates going higher or business dropping off or increasing a bit or margins going up or down a slight amount. It doesn't have to be complicated just to do some modeling, and I think you can develop a comfort level with the cash and cash equivalents that you would need.
Okay. We've sort of reached the magic 1 hour mark, and I would like to sort of put in a last call for any more questions. And if there are none, then I'm going to sort of draw this to an end because I know other people have to get on to the rest of their day. So any last-minute questions? Okay. Well, let's draw this to an end. Roger, Bob, thank you very much for all your help, and I hope all of you on the line have learned a few things about what to expect or what to watch out for over the next, let's say, the next 12 months. So with that, I am going to end today's webinar. Thank you for attending, and please stay tuned for our next webinar series. Goodbye, all.
Bye. Thank you.
Bye-bye. Thank you.
Thank you, Bruce.